In this presentation, I give a description of the currency forward and futures market. The currency market is also referred to as the foreign exchange market or the Forex market. And I define the currency forward contract as a binding agreement between two parties to buy or to sell a currency, some underlying currency, at a pre-specified price. The price of a currency is called exchange rate, and the delivery would be made at a pre-specified future date. As an example, you agree to sell $100 to a counterparty at the exchange rate of $1.05 per euro 6 months from today. So 6 months from today is when delivery will take place. And so the three terms of a currency forward contract are in place here. The first is the underlying currency. In this case, it's US dollars. The second is the pre-specified exchange rate. The exchange rate at which the currencies will be exchanged. And here it's going to be $1.05 per euro. And the pre-specified date in the future. And here it's 6 months. So typically, forward contracts can be done with maturities of 1 month, 3 months, and 6 months. But they really can't be done for any period. It's a one-on-one type of affair between you and the counterparty. The counterparty could be a money center bank that helps you buy and sell foreign currencies in the futures market. In the forward market. So here's a quick example, a simple example rather, of an American wishing to purchase 2 British cars. Each car sells for 10,000 British pounds sterling, and so the 2 cars cost 20,000 pounds. At today's exchange rate, the cost for the 2 vehicles would be $30,000. Now though, however, the delivery is expected 90 days from now. And let's say that 90 days from now the dollar has depreciated, which is your fear if you're importing something from overseas. Because if the dollar has weakened to, in this example, $1.75 per pound, that means that the 2 cars costing 20,000 pounds will now set you back an extra $5,000, as I show here. So that's become quite much more expensive than you thought, simply on account of the depreciation in the value of the dollar. Now, if on the other hand you locked in a forward rate at, let's say, $1.61 per pound, that means that regardless of what the prevailing exchange rate is, when is it now? 90 days from now, that you would still be exchanging your money at the rate of the agreed upon rate of 1.61. So that means the 20,000 pounds, when you go to purchase them in the currency markets at this rate of 1.61, you'd be paying 32,200, which is the agreed upon rate. And therefore, as in this case, rather than pay 35,000 pounds, which is how much it would have cost you, as you can see right here, you would now be paying the agreed upon rate of 32,200. Now, the good thing about this kind of transaction is you've hedged the uncertainty associated with currency fluctuations. So right from get-go, you know for sure that it's going to cost you 32,200 bucks, and not have to have heart palpitations as to what the exchange rate would be at the point of delivery. So now, the futures market, though, is a much more sophisticated derivatives market, more so than the forward market. The two are really the same. Either case, it is a binding agreement between two parties to buy or to sell the underlying currency at a pre-specified price on a pre-specified future date. So the two are really the same. Now, there are some important differences, one of which is that futures contracts are exchange traded. So you're going to have to go to a physical exchange like the Chicago Mercantile Exchange, for example, to trade in the futures market. Forward market, regardless of what the underlying asset is non-exchange traded. It's a direct transaction between the two parties. So also another feature of the futures market is that contracts are standardized. For example, if you want to buy and sell pound sterling, each contract has a size of 62,500 pounds. For the euro, it's 125,000 pounds. If you want to buy and sell crude oil, these are now commodities. Crude oil, the deliverable size is 1,000 barrels. For corn, the deliverable size is 5,000 bushels. Now, you could also buy and sell stock indices like S&P 500. The size per contract is $250. It could be $500 too, but these contract sizes are set by the exchange in which these assets trade in the futures market. Now, let's look at the pound sterling, for example, with a contract size of 62,500. Now, suppose the quoted futures price is $1.6168 per pound. That tells you that the price per contract is going to be $101,050, which is the contract size of $62,500 multiplied by the futures price. So the futures market, you can see it right here. You can see some of the important assets sold by visiting the CME website, Chicago Mercantile Sale Exchange website. Now, this website, this is cmegroup.com. You hover your cursor over trading, and for foreign exchange, which FX, come down here and click it. There's a bunch of other stuff that are traded, but we're interested in the FX market. Click on it and scroll down here. You see the major currencies that are traded in the futures market. So let's say we choose to look at the Euro futures contract. So you click on it. When you click on it, you could also beforehand go to contract specs. When you go to contract specs, you're going to see, for example, the contract units, which is the same thing as contract size, is 125,000 euros. And then you see a bunch of other important stuff about this particular contract. So if you go to settlements right here, you see the future settlement prices for the most recent trading day, in this case Friday 3rd February 2017. So now here on the left column, you're going to see the different maturity months. So for example, on this trading date, a seller and a buyer, they agreed to buy and sell one Euro futures contract with a settlement price of 1.07815 US dollars per euro. So this is just a little bit more than $1.07 per euro. On the same day, February 3rd, parties agreed to buy and sell one Euro futures contract to be delivered in June. The first one is to be delivered in March, which is a month ahead. The next one is going to be June delivery of 2017, and the settlement price there is 1.0832 per euro. Now, these are, as the bid goes on, the additional maturity dates that investors have locked in prices for, as you can see. Interestingly, you find that it appears on this date, at least, that the longer the maturity of the contracts, the higher the settlement price. Future settlement price is analogous to the closing price in the stock market. They are not identical. Settlement prices reflect the last few trading prices of the day and are calculated in some specific ways by the exchange. In any event, these prices, as you can see, for this particular contract, Euro futures, show that the longer the maturity, the higher the settlement price, as you can see right here. This type of market where futures prices are higher, the longer the maturity, is referred to as a contango market. If it had been the other way around, where the longer the maturity, the lower the futures price, we would have called it a backwardation market. Now, to learn more about these features, you'd have to take a course in derivatives and futures and options at least. Alright, going back to the presentation. Now though, let's say that you have million pounds sterling that you're an American and that you're considering bringing back to the United States. Now, currently, suppose the exchange rate is $1.52 per pound. That means that the current value of this inventory of money is 15.2 million US dollars. So now, if you wish to hedge this, in other words, if you wish to cover yourself and not be exposed to adverse changes in the currency, in the value of the currency, then you would need to hedge enough. You'd need to buy and sell enough currencies to get yourself fully hedged. Now, to do so, you'd have to construct the hedge ratio. A hedge ratio will kind of give you the number of contracts that you should buy or sell so as to at least try to fully cover your spot position. Your hedge ratio is equal to the spot price divided by the futures price. The spot value of your inventory being 15.2 million US dollars and the future settlement price here being 101,050. 101,050 is right here. This is the futures contract price, which is price per unit, so to speak, multiplied by the contract size. So this comes out to 150.42 and change. However, contract sizes cannot be traded in fractions. So you got to round up or round down. Here, round it down to 150. So this tells you that if you wish to sell futures, pound futures, to cover this position, you'd have to sell about 150 contracts. You'd have to sell 150 contracts, period. And then in the same way you interpret these other contracts hedge ratios down here, which is basically the value of your inventory, the current value of your inventory, which is a spot asset, divided by the contract size. The contract sizes are shown here. All right, this is the market quotation in 2011, and if you go to the futures market, you saw that right now Euro futures are selling right now for about $1.07 and change. So a quick example, you can pause this tape and read the story out here, but this is a case where, say, currently the spot exchange rate is 1.626 US dollars per pound, and you have 10 million pounds with a current value therefore is $16.26 million. So you have 10 million pounds in the UK and you're contemplating bringing this money back to the US sometime in the future. So this is the picture out here. So this is today, June 1st, and you're going to be bringing this money back to the US on September 1st. So what you're going to do is to hedge your position. You're going to sell December futures. So in most cases like this, you want to choose a delivery month, a futures maturity month that's a little bit beyond the actual time of activity. If the two are together, it's probably going to create a little bit of a turbulence for the hedger, trying to lift the hedge and as well trying to get the money over and stuff like that. But you're going to see how this works out. So going back here, again, the 10 million British pounds sterling is worth $16.26 million today. So you're going to use the December futures contract, which right now, let's assume it's selling for $1.615 per pound. And given that the size per contract is 62,500, it means the contract size, which is a product of these two numbers, is 100,937.5. So now the question is, how many contracts should you sell so as to hedge your position? This money right here. Again, is S over F, which is your spot position divided by the futures contract price. Spot refers to the current value of your assets, which is 16.26 million. So your 10 million British pounds is worth $16.26 million right now. That's what you see here. So you divide it by the contract price to get the approximate number of contracts. Again, you got to round up or round down. So to hedge, therefore, you're going to sell 161 contracts. Whenever you sell futures, it's called a short hedge. Why are you selling futures? Because you're going to be receiving 10 million pounds in the future down in September, and you're going to be selling it to get dollars. and therefore your futures activity position here is going to be to sell British pound sterling futures contracts. How many contracts? 161 of them. So now, hedge lifting dates, which is this date right here. What happens? Well, let's say that on this date, the spot markets, in the spot markets, exchange rate is $1.517 per pound. So as you can see, if I go back here, the price per pound sterling has dropped from 1.626 to 1.517. Of course, if you are bringing pound sterling into the US, this is not good news because it means that your 10 million pounds is now worth less. It's now worth only $15.17 million, down from, I go back here, 16.26 million. Now then, in the futures market, let's assume that on this date, that contracts with expiration in December, the same maturity month that you selected, now cost 1.505, down from, if I go back here, down from 1.615. So December futures back in June cost 1.615. Now in the month of September, they now cost 1.505. So that too has gone down. So the spot price has gone down, futures price has gone down, and this means that the contract price is going to be the size per contract 62,500 multiplied by the futures price of 1.505, and that's it right here. So now what you do in the futures markets, check this out, is to reverse your position. At the outset, let me go back here. To hedge, you sold 161 contracts. So now to reverse your position, called offset, you're going to buy 161 contracts. So you do the opposite so as to get yourself out of the market. By doing the opposite of what you did at the outset, it kicks you out of the futures market. So this is the situation at the end of all of this. Now though, you're going to look at your profit and loss on your spot position and separately look at your profit and loss on your futures position, and then add those two together to get your hedge profits. So on the spot position, remember at the outset the value of your 10 million pounds was 16.26 million US dollars. Now in September it's worth only $15.17 million, and so you incur a loss of $1,090,000. Sadly, the value of your 10 million went down by this amount. Now though, but in the futures market, you sold futures. If I go back twice right here, you sold 161 contracts, and the price at which you sold futures back on June 1st was this per contract, 100,937.5. Now subsequently in September, the price per contract has dropped to 94,062.5. The difference between those two, which is 68.75 multiplied by the number of contracts in play, gives you a futures profit of 1,106,875. So this is the profit per contract because remember you sold for this amount and bought it back to offset your position for this amount. So obviously when you sell something for more than you buy it back, the difference is your profits, which multiplied by the number of contracts in play gives you your total profit right here. So as you can see, you lost this amount in the spot market, you gained this amount in the futures market. Combine the two, that's what I did here. That gives you your hedge profit of 16,875. So, you get a few pieces of chicken right on top of this game, which is good for you. If this were a perfect hedge is theoretically a hedge where the loss in one position is exactly equal to the gain in the other position. Now, in cases such as this, it's not a perfect hedge, but it's definitely the outcome that puts a little smile on your face.